Welcome to Iron Financial, the place we come to forge a stronger portfolio by cutting right through all the market weakness. Today, we are putting on the hard hats and going deep to inspect a true titan of industry, Honeywell. Now, they are in the middle of this massive, and I mean massive, deconstruction project. They're literally tearing the company apart with the promise of building something leaner, meaner, and way more powerful. But you know, demolition, it's a dangerous game. So we're here to do what we do best: stress test their blueprint, kick the tires on the foundation, and figure out if they're actually forging a new titan or just walking investors straight into a trap. Let's get to work.
Right, let's just cut straight to the chase here. Management, of course, is selling this whole thing as a strategic masterstroke. They're talking about unlocking value, creating these three nimbler, more focused companies. You know, what the street loves to call pure plays, right? Each one specializing in its own industry. But look, anytime a $100 billion giant starts breaking off huge pieces of itself, you have to stop and ask the really hard questions. Is this truly about creating shareholder value? Or is it just a clever way to mask some underlying weakness in the core business? Is this a controlled demolition, or is the foundation already cracking under the strain? That's really the core conflict we're going to dig into today. Is this a move of strength, or is it a move of desperation?
All right, so here's our inspection plan for today. First, we're going to look at the headline numbers, the shiny exterior they presented to the market. Then, we'll get into the actual deconstruction plan, how they're forging this new Honeywell. After that, it's time to get under the hood, inspect the performance of the core components, the individual business segments. Then comes my favorite part, the stress test. We are going to go searching for cracks in that financial structure. We'll follow that up by analyzing their blueprint for 2026 to see if the plan actually holds water. And then finally, of course, we'll deliver the Iron Financial verdict. Let's dive in.
Okay, let's start with the story Honeywell wanted Wall Street to hear on earnings day. Because on the surface, you look at the numbers and they look powerful. This is the polished steel, the gleaming facade they put right on display. And honestly, you can see why the market initially reacted with some optimism. The headline figures, they paint this picture of a company with some really serious momentum behind it.
So the first number you have to look at is just a monster. 23% organic orders growth. We got to be really clear about what this means. This isn't just revenue from last quarter. No, this is the lifeblood of their future earnings. This is the demand for what's coming down the pipe. A 23% surge tells you that despite all the noise, all the chatter about the economy, customers are lining up and they are signing checks. This points to some powerful underlying demand, especially in their long-cycle businesses like aerospace and energy. It's an absolutely crucial, forward-looking indicator of strength.
And all those orders? They feed directly into this next number, a record-breaking $37 billion backlog. Just think about that for a second. Think of this as revenue that's already been sold. It just hasn't been built and delivered yet. It is a massive buffer against economic uncertainty. So while other companies are out there frantically hunting for new business, Honeywell is sitting on a mountain of guaranteed work. This gives them a really solid foundation of revenue visibility for quarters, maybe even years to come. It's a powerful statement of stability in a really volatile market. But a shiny exterior can sometimes hide a very different story underneath.
And hold on a second. This is exactly what I'm talking about. 11% organic sales growth. At first glance, it looks fantastic. You see that number and you think, wow, this company is firing on all cylinders. But then you look a little closer. You read the fine print. You have to strip out a one-time, non-operational agreement with Bombardier. And once you do that, the real underlying growth is a much more modest 6%. Now, don't get me wrong, 6% isn't bad, but it's not the blockbuster 11% they're leading with. It's a perfect example of why we have to look past the headlines. The story is already way more complicated than it appears on the surface.
Okay, so we've seen the headlines and we've already found the first little asterisk next to the numbers. Now let's get to the real core of the story, this massive portfolio transformation. And listen, this isn't just some minor renovation. This is a complete deconstruction and reconstruction project. The goal here is to break up the old, sprawling conglomerate into these more focused, more agile companies that can react faster and, at least in theory, grow faster by attracting investors who want that specific industry exposure. It's a bold, high-stakes maneuver.
And let me tell you, they are not wasting any time. The pace of this transformation is aggressive. I mean, just look at this timeline. The Solstice Advanced Materials business. It's already out the door, spun off and trading on its own. Next on the chopping block are the Productivity and Warehouse Solutions businesses, which they're planning to sell off entirely in the first half of 2026. And then the main event, the spin-off of the massive Aerospace division. That's slated for the third quarter. This is a rapid-fire sequence of moves, all designed to completely reshape the entire company in under a year.
Now, to pull something like this off, you need a world-class construction crew. And Honeywell is bringing in some absolute heavy hitters. On the main Honeywell board, they've added Indra Nooyi, the legendary former chair and CEO of PepsiCo. I mean, you don't bring in someone of her caliber unless you are dead serious about long-term strategy. And for the new aerospace company, they are stacking the deck. The CEO is a tenured veteran from inside the business, Jim Courier, but look who they brought in as non-executive chair. Craig Arnold, the guy who ran Eaton Corporation, another industrial titan known for operational excellence and super disciplined capital allocation. This is not the B team. They are assembling a leadership group with deep experience in running massive industrial operations, and that signals they are deadly serious about making these new entities succeed right from day one.
All right, so the strategy is ambitious, and the leadership looks solid. But, a great blueprint and a great foreman, they don't matter if the raw materials are flawed. It's time we move past the strategic vision and get our hands dirty. Let's get under the hood and inspect the core components. Are the individual business segments, the engines of this machine, are they actually firing on all cylinders? Or is this whole structure being propped up by just one or two strong parts?
And now this is where the picture gets very clear. On one hand, you have two absolute powerhouses. Aerospace Technologies, even if you exclude that Bombardier deal, is growing at a powerful 11%. That's the engine of growth, right? It's benefiting from the travel rebound, strong defense spending, and then you've got building automation, a solid foundation, up a very respectable 8%, driven by all this demand for energy efficiency. But that's where the good news stops. Just look at the rest of the portfolio. Industrial automation, stalling out at just 1%. Process automation is completely flat, zero growth. And worst of all, energy and sustainability is actually shrinking, down 7%. It is a significant drag on the entire company. This isn't a balanced machine. It's really a tale of two companies living under one roof.
And that brings us to the crucial point. When you look at these images, you see the two pillars holding this whole company up: jets and buildings. Aerospace and building automation are doing all the heavy lifting. The other three segments are either treading water or they're actively sinking. So the big question becomes, is this a stable structure? What are the implications here? Well, it means that any slowdown in air travel or commercial construction could have an outsized, really negative impact on the entire company's performance. Relying so heavily on just two divisions while you're going through a massive, complex corporate breakup, that introduces a significant amount of risk. The balance of the portfolio is questionable, and that is a glaring weak point we are about to pressure test.
And that brings us right to the stress test. A structure is only as strong as its weakest point. We've looked at the surface, we've examined a plan, we've inspected the parts. Now it's time to apply some real pressure. We're going to search for the cracks, the hidden faults in the financial structure that might not be so obvious at first glance. This is where we see if the company is built on solid rock or on shifting sand. Let's see what happens when we start to push.
So the first hairline crack appears right here. The company reports earnings per share of $2.59, beating Wall Street's expectations. That's the number that gets all the headlines. But at the exact same time, their top-line revenue number, $9.76 billion, it actually missed projections. This is a classic yellow flag for investors. When a company is beating profit targets while failing to meet its sales targets, it often means they're not growing as fast as they seem. It suggests they're hitting their numbers by cutting costs, not by actually selling more stuff. And it raises the question, is that profitability sustainable, or are they just squeezing the lemon dry?
But to be fair, that cost management is incredibly strong. I mean, you just can't ignore these numbers. An operating margin of nearly 19%, a net margin over 15%, and an EBITDA margin over 25%. These are powerhouse figures for an industrial company. This shows that management runs an incredibly efficient machine. They are absolute masters at managing costs and wringing every last drop of profit out of every dollar of sales. So, yeah, while the revenue miss is a concern, this robust profitability is a clear sign of financial strength and discipline. It's a massive counterargument to the idea that they're in some kind of trouble.
This, however, this is not a hairline crack. This is a potential fault line running right through the foundation. $18.5 billion in new debt issued over just the last 3 years. That is a staggering amount of leverage. So while they're preparing for this massive, expensive, and really complicated breakup, they've been loading up the balance sheet with debt. This is the single biggest risk factor we've identified. You have to ask yourself, is the company taking on way too much financial risk at the worst possible time? A heavy debt load can crush even the strongest company if things go south, especially if interest rates stay high or a recession hits and those cash flows tighten up.
Okay, but we have to provide the crucial context here. The analysts over at Guru Focus, they looked at this exact issue. And what's their take? Yes, the debt-to-equity ratio of 2.21 is high. They don't sugarcoat it, but they call it manageable. And why? Because of the company's ability to generate massive amounts of cash. The argument is that as long as that cash keeps flowing in, they can service that debt without a problem. It's kind of like having a really big mortgage, but also having a very high and very reliable salary. It's a calculated risk for sure, and their powerful cash flow is the key mitigating factor.
But is it though? Let's drill down on that strong cash flow argument. The headline number is a spectacular 48% growth in free cash flow. I mean, that looks like a fire hose of cash just pouring into the company. But once again, we have to pull out that one-time Bombardier agreement. And what happens when we do? The real underlying cash flow growth is 13%. Again, 13% is good, it's solid growth, but it is not the 48% blowout figure that makes a high debt load feel comfortable. This just shows that even the primary defense for their biggest financial risk is it's self-inflated by a one-off event. The foundation might be a lot more brittle than it looks.
Okay, so we've pressure tested the current structure and found some definite points of concern, especially around that debt. So now let's shift our focus to the future. Let's inspect management's official blueprint for 2026. Is their guidance built on a solid, achievable plan? Or is it based more on hope and a bunch of best-case scenarios? This is where we find out if the architects of this plan have a realistic path to success.
Well, these are not the numbers of a management team that's worried about the debt or the complexity of the breakup. They're projecting confidence right across the board, steady top-line growth, healthy EPS expansion, and a cash flow machine that just keeps printing money. They see sales approaching $40 billion, with organic growth between 3 and 6%. That implies they believe their weaker segments are going to stabilize. They're promising investors a 6 to 9% boost in adjusted earnings per share. And that free cash flow number, over $5 billion, that is absolutely critical to servicing their debt. The question is, how in the world do they plan to get there?
So the crucial point here is understanding where all that earnings growth is supposed to come from, and management is being very clear about this. The overwhelming majority of the increase, about 64 cents per share, is expected to come directly from segment profit growth. This isn't financial engineering, it's not some huge share buyback program driving the number. They're telling us it's coming from the old-fashioned playbook, selling more stuff from their backlog, becoming more productive in their factories, and executing on pricing. This whole path is meant to offset their strategic investments in high-growth areas like that quantum computing venture Quantinuum. It's a high-quality, pretty straightforward path to hitting their numbers.
But how do you expand margins in the middle of a chaotic corporate breakup? I mean, that's the billion-dollar question, right? And this lays out their 4-step playbook. First, disciplined pricing. They expect to raise prices by 3 to 4%, assuming they have the market power to make that stick. Second, they're going to leverage the sheer volume of that $37 billion backlog to improve efficiency and absorb fixed costs. Third is the classic Honeywell move, relentless productivity gains and cutting fixed costs. And fourth, and this one is key, they're planning an aggressive reduction of stranded costs. That's all the corporate overhead that gets left behind after a business is spun off. It's a clear, it's a logical, and it's an operationally focused plan. The real question is, can they execute it under all this pressure?
All right, we have reviewed the headlines, we've inspected the deconstruction plan, kicked the tires on the components, stress-tested the financials, and we've analyzed the blueprint for the future. We've seen the strengths, right? The powerful backlog, the elite new leadership, the robust profitability, and we've seen the weaknesses, the lopsided growth, the revenue miss, and that massive pile of debt. So it's time to weigh it all and deliver the iron financial verdict. Is Honeywell's big breakup an opportunity, or is it a trap?
So here's the bottom line. This is a heavy lift transformation. Honeywell is undertaking a massive, complex, and really expensive project to forge a nimbler, more focused industrial machine. The underlying foundation, which is powered by aerospace and building automation and their incredible profitability, is strong. They have a solid plan and they have the right people to execute it. But, and this is a huge but, that $18.5 billion debt load is a critical watch point. It puts immense pressure on their execution. If they stumble, that debt becomes an anchor that could pull them down. There is a clear opportunity here for long-term value creation, but the risks are very real and they are significant. So our final verdict? This is a hard hat area. The key indicator to watch is the performance of those non-aerospace segments after the spin-off. If they can stabilize and grow, this plan works. If they continue to be a drag, that debt load is going to start to look catastrophic.
proceed with caution. Thanks for joining us on Iron Financial.